welcome. You're watching Business Today TV. I'm Sakshi Batra, and this is a show where we'll help you understand the closing action on the D Street, an overview on the markets from an expert, and also the sectors that are buzzing the most in trade and what should be your strategy on some of the stocks that are also in news today. All of that we will discuss in the coming minutes, but do stay tuned. First up, a quick look at how the markets are doing at this point in time. The Sensex and the Nifty now in the green, so they've reversed the losses in the first half of trading session. Slight gains coming in for the Nifty, absolutely flat with a positive bias at 17,630. Also with the Sensex, it's moved up higher by 60 odd points right now, 59,691. The current level for the Sensex, that's up by 0.1%. Although it's been a very tight range that the markets have been trading in for the last 4-5 trading sessions as well, and we've been seeing similar momentum today. But the good point is that we are slightly moving higher in trade. In terms of the top gainers today, you do see some stocks from the FMCG basket like ITC is at 408 all-time high levels, almost 2% up. Britannia is up by 1.5% at 43.22. Apart from this, you also have some gainers from the IT pack like TCS and HCL Tech have recovered in trade. Asian Paints are moving higher as well. So some of those IT stocks that have been dragging for long because of the HCL Technologies results and steady quarterly earnings over there after the disappointment of Infi, that's leading to some recovery in the IT pack. On the other side, which are the stocks that are not doing too well? Well, it's HDFC Life, Tech Mahindra, Adani Enterprises, SBI Life as well, Hindalco, some of the metals pack that is trading on the downward trajectory today. A mixed bag when we talk about the sector movements as well. But let's welcome our guest on the show. Mr. G. Chokalingam joins in. He's the founder of Economics. Welcome, sir, and thank you so much for taking the time out for this discussion. I'll take your first outlook on markets as well. A very sideways momentum in the last 4 to 5 trading sessions so far. After that one-way up move of 8-9 sessions, we've been stuck in a range. What will it take for the markets to come out of this range, you believe?
Already the small caps started improving in the last 1 month, which were underperforming. So what I believe that there is no need to worry too much about the market. Market is most unlikely to fall badly from current level in the short term because though the GDP growth is revised downward by global institutions, still whatever projected close to 6% would be the fastest among the major economies in the world. Then if you take individual parameters, whether you take NRI remittances or banking credit or banking assets quality of assets of the banks, or the last 2 crops, Kharif crop, Rabi crop, then PLI schemes, capex plan. So I can list out a lot of macroeconomic parameters which are conducive, except forex reserves and goods exports. The goods exports also, the adverse effect is mitigated by solid service exports, and the forex reserves dipped because RBI has been selling a lot of dollar in the market. So the point I am saying is that Indian economic conditions are quite robust in relative terms. And the only risk factor would be the monsoon, not from the growth perspective, because agriculture sector accounts for only 17-18% of the total GDP. Even failure of the monsoon will not impact the growth much. But from inflation perspective, it can be a concern. Otherwise, already IMD has forecast normal monsoon. So I believe the current momentum in the market should continue, which we saw in the last 10 days. And particularly more so would be in small and mid-cap stocks because they have underperformed substantially category as a whole.
Okay, understood that. Let's focus on some of the pockets that are buzzing in trade today, sir. I mean, FMCG seems to be springing up once again. We've seen sporadic moves come in on, say, stocks like Nestle, Britannia. ITC, of course, is sitting at fresh highs as well. We've also seen some of these stocks coming back into news flows as well. Anything from this basket that you particularly like?
Certainly. The FMCG sector, the retail investors should stay invested because historically it is proven from 2008. So whenever the rate cycle keeps moving up, in India, the FMCG sector is best positioned to provide safety to the investors. It was repeatedly proven in the last 10-12 years.
Right.
And of course, still it is not clear whether rate cycle is over. I believe it is getting over. So therefore, one should stay invested. And within that FMCG basket, I would prefer stocks like HUL and
Okay.
3M India, and lastly even Britannia. So these are the stocks I would strongly recommend. Among them, HUL, the most preferred stock according to me, because the oil price again last few days corrected. That is also positive, and HUL also quite aggressive in the rural market. So if monsoon is good, HUL would be a major beneficiary.
Okay, so HUL is your preferred pick, and apart from that, Britannia and 3M India. Let's also talk about ITC, sir, because that's been the stock in news flows. It's been the stock that everybody is talking about. After surging by over about 50 odd percent in FY23, I wanted to understand if there is further upside that one can really look at ITC going forward from here. We're seeing the stock is at all-time high levels at 408 right now, and there seems to be no stopping. But I want to understand from you, is there enough clear visibility when you talk about the earnings, cash generation, which may help ITC continue to deliver going forward from here?
See, it was very unfair, to ridicule ITC when it was 200.
Yeah.
There was an extreme, criticism. Now there is extreme optimism in the market when it has crossed to 400. That is the way the market behaves. Retail investors should be very cautious because, for instance, Maruti touched 10,000 rupees few years back. Then the whole, the market became gala about Maruti and saying that, it is going to jump much beyond 10,000. So these things keep happening. But you have to look at the valuation. At 400, yes, certainly the valuations are not attractive. Two things you have to remember: the government needs to collect more and more money from the liquor and the cigarettes. Logically, from economic perspective, it is inevitable. And second, the government is also sitting on the sideline to sell a lot of stock in the market.
Yeah.
So therefore, one should slowly start booking the profit and then look for some other attractively valued stock within the FMCG space.
Right. Now you did point out that your preferred stock is HUL, but the question that most investors would get stuck with is whether one should go with ITC or one should go with HUL in the long run, and in the long term, which one can deliver better returns. Now, on the one hand, we do know that HUL is the poster boy of the FMCG space in India, linked with a global peer and the global parent company. But ITC as a whole is a big conglomerate, goes beyond FMCG into cigarettes, into hotels, into papers. It's a huge basket that one can really cater to. How should one decide which one is a better pick?
No, for very long term, definitely, I would not say that you just stick with a stock, irrespective of structural changes happening. Because look at ITC, for more than 2 years, it was underperforming. Even HUL underperformed in 2013 for nearly 2 years. It was also ridiculed at 464. So the point I'm saying is that there is a tremendous structural change in the market. You have to be a long-term investor, but you should not stick to any stock blindly for long term. The fundamentals keep changing. We had seen hotel business coming under pressure, paper industry coming under pressure. So these things keep changing. So therefore, for time being, I would say that short to medium term, HUL looks far superior to ITC. But in the very long term, you have to really see how the fortunes are changing. And yes, it is, having a many verticals, but it's all in price. We have done a SOTP. So even if you give 30, 40, 50 PE for, the hotel and paper, still
Yeah.
this 400 rupees is fairly valued.
Okay. And when we talk about both stocks like HUL and even Britannia, they've actually shown margin resilience, they've shown sales resilience, and that is also getting reflected in the stock prices. Now, investors would believe that, one does not make money when one buys stocks which are at P multiples of 50 or 60. But it looks like both HUL and Britannia have proven the naysayers wrong. But going forward from here, do you think that even at these levels, there would be enough steam for both of these, big FMCG giants who are now looking to even revamp, especially for Britannia as well? They're getting into different categories now, product categories as well, baked goods, for example. They are looking at a lot of innovation. They would still have a lot of upside despite such high valuations that they trade at?
Certainly, you posed a very interesting question. The person who has been learning from the market for decades can definitely appreciate this question. The IP, whether how long one can chase them and buy. Certainly, in FMCG space, one can compromise and go with IPE, which proven to be a fairly successful strategy for last 3, 4 decades for two reasons. One, uh, these FMCG companies continue to remain as a solid growth stock. You know, only when the monsoon failed, the drought was there, they might have probably failed to grow. But otherwise, if you take last 3 decades, most of the time they have been growth stock. So even if you buy, HUL at 60p or Nestle at 80p and you go wrong only in terms of time, 1 year, 2 year. So this is a distinction the retail investors have to understand, because there are many small mid caps, even large mid caps. They buy high PE without understanding the difference between the FMCG and other set of stocks. Where the growth is temporary for 1 or 2 quarters and then they pay high PE. Like for example, Thyrocare,
Yeah.
what kind of PE it was enjoying. Some of the hospital sectors, so they were not able to grow consistently. So therefore, definitely one can go, with the FMCG and compromise on the PE evaluation.
Okay.
And as I said, but every quarter you analyze within the FMCG which segment has a better. For instance, tomorrow if oil price goes to above $100 per barrel, ITC would be better than the HUL. You
Okay.
know,
Okay.
or if there is a drought and the wheat crop gets impacted very badly, then Britannia will be the worst performer among all. So these are the kind of things one should evaluate every quarter, and then within the sector you select the right stock and stay for long term and even pay IPE.
Right. Also wanted to understand, sir, recently we've seen big boy Reliance Industries, which is slated to come out with the earnings in the evening today, has been upping its ante when it comes to FMCG foray. It already has the largest supermarket chain in the country. It's now even present in several fast-moving consumer goods segments as well. Could that pose a threat to these big giants of FMCG?
Very interesting question. In fact, I don't own any share of Reliance, but I am a big fan of Reliance. In fact, I have written an article saying that the Reliance is emerging as a mini economy,
Okay.
for mini economy in itself.
Okay.
It has diversified into retail and mobile telecom, and it built a size. Now it is getting into green energy, FMCG, whatnot. Now they have already proven their ability to scale up the business and make it profitable. So I firmly believe that wherever they foray into, whether it is green energy or the fintech or in media business or in FMCG, any business, I'm pretty confident they will build a scale and they will grow. And second, if you see very interestingly, they are moving away from the sector which have a lot of the regulatory interventions, and move towards the population driven, the consumer theme driven the segments and sectors, and also the new economy. So in next 3 to 4 years, I will not worry about what results come today, but I would believe that in next 3 to 5 years, Reliance industry would emerge as a Reliance economy in itself, and I believe in 4 or 5 years it should minimum double from the current level unless there is some problem for the whole stock market. Now coming to your last question on FMCG foray, whether other companies will be impacted, it's a long way to go, because in mobile telecom many people vanished because they had a weak balance sheets, and some of them had a weak management, whereas FMCG, let us not forget the fact that all are giants and many of them are backed by the foreign MNCs. So that they also have equal cash, brand. So it's not going to be easy. But
Yeah.
what I believe that still Reliance will be successful, because they are acquiring small brands which were there for decades and which are available at the throwaway prices. So this is the smartest strategy of finding their own segment without hitting directly the MNCs, but still keep growing in size. So
Sure.
therefore, the existing players may not be affected badly.
Absolutely. And lastly, sir, I wanted to understand your own expectations from Q4 when it comes to the FMCG basket. What can you expect?
It will be single digit growth. It's very difficult to expect, unless there is any other income or exceptional income, because the volume has been growing in single digit. There has been some input inflation impact also. So it will be around, anywhere from 8 to 12% year on year growth.
Okay. What about these smaller companies like, Imami and, Colgate Palmolive, Dabur? How are you looking at these versus the bigger peers?
I looked at them. They're also great companies, but the valuations are much more stretched, and their growth has come under test now as compared to these giants. So therefore, better to go with these giants.
All
And
right.
also,
Got that.
I've been avoiding paint companies because the market structure is changing. The new capacity being built is 50% of the existing capacity. So I believe, as a student of economics, this is a massive adverse structural change for the industry. And also I have a view that in the 6 months to 12 months, the oil price might cross $100 per barrel.
Okay.
That also would
Okay.
be negative. So one should, within FMCG, one should avoid paint companies.
Got that. So where exactly are you positive amid the earnings season, sir?
It's a tough time. Only banking sector, because only the
Okay.
banking credit is growing in a strong double digit, 15-16%, and net NPA at 10-year low. And so therefore, only the banking sector would do extremely well, followed by the FMCG. But again, as I said, at 10 to 12%. But many other sectors will have problem. Pharma would be one of the worst underperformers. Even the chemicals would be underperformers. And we have been seeing what is happening to IT. But still, I am comfortable with some quality small IT companies, because the whole industry is not growing. So there is
Yeah.
a possibility of consolidation in the IT industry. There could be scope for acquisition of small, good quality IT companies.
Got that. Well, thank you so much, Mr. Chokalingam, for being with us and discussing with us so many insights about various sectors that we discussed today on the show, and helping our viewers really make sense of how to approach them right ahead of their earnings as well. Many thanks. Good. Always a pleasure having you with us. And let's look at the markets as well one more time. We're just about 12 minutes away from the markets closing. It's a mixed trend that you're looking right. Absolutely flat trade with a negative bias on the Nifty with 17,619 kind of levels. On the other hand, the Sensex is still up in the green, but absolutely flat with just about 22 points of a gain, 59,650. Around those kind of levels is what we are looking at. Will we see another day of lackluster closing as far as the markets are concerned? We'll keep an eye out on that, and you can also track all the market momentum with us on Business Today TV. So don't forget to subscribe to this platform, and also continue to engage with us on our social media as well. That's on Facebook, Twitter, LinkedIn and Instagram. Until then, thanks for tuning in.
Hello and welcome to Easynomics. I'm Siddharth Zarabi and we are discussing the topic of whether heat waves can impact